My name is Michael Gayed, publisher of the Lead Lag Report. Joining me for the hour is Mr. John Authers. John, I know you've been in business for a while. A lot, I'm sure you can bring to the table as far as your experience with Bloomberg. But introduce yourself to the audience. Who are you? What's your background? How'd you get involved, interested in markets? What brought you to Bloomberg, and what are you doing currently?
Okay, right. I'm actually these days an American citizen, but as you can probably hear, I'm native from Britain. I have been a journalist. I've been a financial journalist since 1990. So basically, straight out of college, and I worked at the Financial Times for 29 years, and I'm now coming up for 5 years here at Bloomberg. And I think I started my first stint of covering the London stock market, as it then was in 1990, when we were just entering what, in retrospect, is rather a quiet bear market, and when the world really was, we can now see, quite a different place. It was exciting if you could find out that some broker had downgraded some stock. There was a lot of work to be done just to find out what kind of action was explaining the moves of individual stocks, and it was very much a bottom-up world at that point. And people paid for the FT because we had page after page after page of in tiny print every stock quoted in London with its price and PE ratio and price to book and so on, which at that point was remarkably a USP. People had to buy us to get it. And they traded during the day with a piece of paper in front of them, which again is quite astonishing that it was that recent. I've covered basically every market crash or every serious incident in the markets, positive and negative, since 1990. So Black Monday and Soros, bet against the pound, Irrational Exuberance Day with Alan Greenspan, the whole of the dot-com bubble, the whole of what happened in 07, 08. I was the investment editor of the FT then, and I've been writing a daily newsletter for the last couple of years at the FT, and then that's what Bloomberg really wanted me to do. I write a daily newsletter on markets, which has told the story of the pandemic and has since told the story of inflation, and we're now getting onto the fight of what exactly is going to be the cost of the fight against inflation, which we're learning more about with every day that passes. But yeah, anyway, that's me. I'm a journalist, and I've really been covering the markets for a very long time. If you look up, you will find there's a couple of books by me which you can still get on Amazon that will explain all about, in which I attempted to explain why what happened in 2008 happened and why correlation had got so high between lots of apparently different markets.
All right, so I definitely want to expand on that, but given your years in the journalist side of things, and as you mentioned, seeing all these tail events and reporting on them, has the nature of the way media reports and analyzes these events changed? Has it become more punditry based, more opinion based, more emotional, as opposed to how it may have been earlier in the 90s, where it was more analytical and dispassionate?
Yes, I think that's fair to say. I mean, a large part of that is the growth of the internet, that everybody does have a voice. We are speaking on Twitter at this moment. So it becomes a much broader field. And as we all know, particularly in politics, the noisier you are, or the more extreme your point of view, the more people will notice and engage. I think I love a lot of CNBC coverage, but I think Fast Money or Jim Cramer is similarly an example of the kind of thing that will get people to look at you. It's not necessarily an example of the kind of commentary or coverage that you might actually want to follow with your own money. I think the other thing, though, that it is fair to say is that I do think coverage is a lot more intelligent now than it was 30 years ago, because it's no longer acceptable just to be bottom up, just to find out who is selling this stock or whatever. You do need to add a lot more value because there is greater competition and because you can move much more swiftly. I think the other thing which is key to the way I've tried to do things, is that there is an advantage to actually keeping your head straight, to being calm and trying to be detached. Again, I get feedback where people thank me for being calm or for being, not sounding too scared about things, which you wouldn't have thought was a source of competitive advantage, but I guess it is. So, those are the things that have helped. I do think the degree of the analytics that are available to us, the degree of the information, I'm sitting in front of my Bloomberg terminal in case I ever need to discuss it while we're talking. The degree of information that's available to you at one click of a button or a mouse now compared to a few decades ago is extraordinary, and that does change the nature of the beast. It puts much more of an emphasis or a need on journalists to be smart and to show. Sorry, one other critical point, which has come with the growth of the internet. People tend not to trust you if you're in the mainstream media. So this is quite comical. I once got a letter when I was at the Financial Times pointing out a mistake. I think we'd said prices when we meant yields. Easy to happen. Human beings produce things. There will be mistakes from time to time. But the letter actually said, the Financial Times can't be wrong, can it? With a question mark. And I actually phoned up that reader and discovered he meant it seriously. He wasn't being sarcastic. It hadn't entered his head that we were capable of making a mistake. That's unhealthy, that people distrust the information they're getting that much. I think at this point, we've gone too far in the other direction, where the fact that I work for Bloomberg, this very powerful data business with an extreme interest in people taking me seriously and believing I'm being honest, somehow or other that has taken us a reason to distrust what I say, that there is an active belief that there must be something wrong with your point of view if you're from the mainstream media. That is an issue, and it becomes very important to demonstrate that you can be trusted, that you should be trusted, and that you can be trusted. Not necessarily that you're always going to get it right, because nobody will, but that you are intellectually honest and trying to get it right.
I do think there's a difference between also just Bloomberg's model versus other financial media models. Other financial media models are you can argue more on the entertaining side because they're trying to get eyeballs, eardrums, because it's ad revenue, right? Whereas Bloomberg, you don't have the same focus on the ad revenue side because you've got the terminals.
Correct, which is a very nice place to be. I mean, I do try to entertain people, try not to make it like a visit to the dentist. Matt Levine, similarly, who many of the people listening, I imagine, will read him every day. It's not as though we're not trying to at least make this an enjoyable, interesting read. But yes, the need to really be noticed and to feign outrage when it doesn't really exist. That I'm glad to say, thankfully, due to the Bloomberg business model, that doesn't affect us. We're not under any pressure to scream about something unless we think we really need to scream about it.
Yeah, and to your point, it's unfortunate that people seemingly can't distinguish between the nuances or among the nuances in terms of how to think about trust. Yes. I've seen the same dynamic on social media. People would rather trust some anonymous, FinTwit account on some news piece that they're reporting than somebody whose whole career is focused on providing accurate, actionable information.
Correct. I mean, again, there are plenty of reasons, particularly in the world of politics, where you can see why people trust the mainstream media less than they used to. And particularly in the case of the dot-com bubble, much less so, in my opinion, in the case of 0708, the financial medium did get things wrong. There was far too much hype around the dot-com bubble. Magazines like the Industry Standard coming into existence and becoming enormous. People got excited by that. I do think in 0708, if you look at the amount of whether the press saw how bad things were going to be, is questionable. Certainly, I would I thought I was asking the right questions, and many others were as well. If you were following the press in '07, you would have known that there were some very, very worrying risks out there. But in general, those two incidents left people, gave people reason to question how much they could trust what they were reading. They didn't feel that they'd been adequately warned.
So, of these books that you've written, you mentioned this idea of co-movement of asset classes post GFC, right? So, lay out for the audience what that argument was.
Well,
I'm going to make the assumption it's ultimately about QE and ZERP and everything about beta.
Well, both before it was. What we saw in the years before the GFC was people thinking they were diversifying by moving into assets that had previously not been correlated with each other, but in fact making the same bets multiple times in different asset classes, with the result that they weren't protected in the slightest when the crash came in '07 and '08. So things like emerging markets, commodity futures, all of these were financialized, became much more of a big deal. Obviously, credit and structured credit. And so and foreign exchange with the carry trade were basically all trades that amounted to much the same thing. So you had this remarkable collapse of everything at once. When you had the response, which is QE, which I'm somewhat ambivalent about. I think it was probably necessary to hold the nose and do it in the first tranche, and it was less justifiable with every further tranche that came. With the advent of QE, money is fungible, and it will go where it can make the most return. And so again, you begin to, if you look at indexes in any number of different geographies, different asset classes, you can pretty much tell how much liquidity is coming, how much central banks and particularly the Fed are trying to prime the pump. So what we possibly have is a very major case of malinvestment, of mispricing. That because there's not been the normal price discovery that you might expect for such a long period, we have a large number of assets that are deeply mispriced, and we don't have, as a range of investors, people who are qualified or who have the experience to deal with that. And the current issues for the regional banks in the US being one very nice example of that a lot of that is played through ETFs, which is another factor, incidentally, in the way correlations increase across asset classes, is that you can bet from the top down, and the tail can wag the dog. And there's at least some evidence that has been happening with regional banks, that people perfectly reasonably sell the ETF, with the result that you then get pressure on individual stocks, and it becomes a self-perpetuating loop. But that's ultimately, I guess, my story, that the provision of easy money, followed by the financialization of a range of products to allow top-down investing, has led ultimately to a situation where there is a large amount of malinvestment that will have to be sorted out. And the great hope for the moment is that somehow or other we can muddle our way through without a major.
You can argue it's also made the markets less fun, right? I mean, no, really, and I say that because look, the reality is, the last decade, really post QE3, the entire cycle is dominated by just a few select large cap, stocks that were driven by market cap weighted passive indices, right? So the FANGs, as we know, right? So it made it quite frustrating for stock pickers, for hedge funds. I mean, speaking about Bloomberg, that Bloomberg cover that shows hedge fund perception as an arrow straight up coming from the crotch versus the reality, right? Which is that it's not as and that's real, right? So, but my point is that it's been I'd argue a very frustrating environment for active allocators, because if everything's acting the same and the S&P is the only game in town, you can't beat the S&P when that's the leader.
Peter Lynch Fidelity style active mutual funds have had a horrible time, and interestingly, so have global macro hedge funds. There's just the ability to beat the market by spotting the next macro move doesn't help you very much if central banks keep pumping money and the macro keeps not moving the way you want it to. So yes, it's made life very hard for many people. I'm a big fan of Charlie Ellis. The notion of the loser's game has intensified, that the people playing the game of trying to allocate assets, it's a smaller pool, and the survivors who are still trying to win are ever better. So the game involves competing against an ever smaller number of ever cleverer people, which is difficult. It's been a very painful time for a lot of people in asset management.
So that actually dovetails nicely to the idea of peak passive. I've had Robin Wigglesworth on a Twitter space not too long ago. I had Michael Green, right? Both of them talk quite a bit about passive investing. That idea of passive, the peak in passive investing has been around for a while, and it seems to keep on getting higher and higher in the flows. How much of this is purely structural, just given the way that 401ks are set up and the availability of funds versus, if you can't beat them, join them as an investor mentality?
A lot of it is very much structural. I'm mentioning Robin Wigglesworth. I sat next to him for about 3 years at the Financial Times, so I like to think I gave him his start covering passive investing. I remember happily telling him a lot about the growth of Dimensional and Vanguard and stuff. There are certain things that really have given an impulse to passive, particularly in this country, that it's very difficult to beat. So if there is a fiduciary standard that you've minimized your costs, then of course any sensible trustee is going to put their money in a very large index fund, because nobody gets fired for putting money in an index fund. The same way that people used to say nobody got fired for investing in IBM. I think also because of the way the nature of investing has shifted with modern portfolio theory, has also unintentionally given a very major boost to indexing, to passive funds, in that if you're viewing the market as in terms of an index, that index becomes ever more important. One of the ways I like to illustrate that is that when I started in the business, people would say they owned a stock or they didn't own a stock. Nowadays, they'll say they're overweight or underweight a stock. If you are in a fund that, and that leads to the very strange contradiction that, say, in Britain, if you've got an index fund in Britain, you've obviously got huge amounts of BP and Shell in it. And if you therefore go below benchmark and say have only 2% of your investment in each of those companies, that means you want BP and Shell to do badly because you're betting on them to do badly, even though you actually hold those stocks, which is a very perverse series of incentives that people face when they invest. So yes, there are strong structural trends moving towards passive. What's happened in the last 5 or 6 years was that you'd had a long period in which the classic Jack Bogle version of Vanguard was dominating inflows. But for the last 5-6 years, we've had outflows from active into passive as well. And what's most important is it's not just the influence on actual passive funds, nominally self-proclaimed passive funds, but it's also about the impact of benchmarks on supposedly active funds. So I don't know how many listeners are familiar with Martin Kramer's Petagisto, probably mispronounced his name, who a couple of academics who came up with research about 15, 16 years ago now, with the concept of active share, where you look at any fund's portfolio in terms of how much it deviates from its benchmark. And if you use that as a basis, if you look at assets as at the active share of the total amount of money that's been invested in large caps in the US, it's quite startling that the total amount of I'm quoting from a very interesting study I wrote up from Mann Institute. At one point before the GFC, roughly 50% of the money held in US investment funds was active. It differed from the main benchmarks. That's now down to 35%. Roughly speaking, the amount that's basically driven by top down by indexes has increased from half of the money devoted to shares in this country to 2/3, and that's a big deal, and it means that the impact of passive is perhaps even greater than it appears from the raw numbers.
Lay out for the audience why that's a negative from an economic perspective. So, from my vantage point,
right.
From my vantage point, the dilemma is very simple, right? I mean, there's a signaling aspect to stock price, and if stocks are moving closer together, you don't really know what the true fundamentals are, because it's technical price movement which causes a degree of obfuscation on the reality of what a company is doing.
Yes, precisely. So you need the part of the idea of the stock market is that a very important part of it is that it encourages capital to go to where it could be best used, and discourages it from going to places where it would be wasted. And it's very hard to argue that that is still happening if that much of the funds that are devoted to the stock market are allocated passively. It actually gets to the point where, providing there are new funds coming in, if stocks get more overvalued, you have no choice but to give more of incoming funds to those overvalued stocks, that they become, that the index can become, providing there is still money coming into the index funds, that the index can become something that actually propels or inflates bubbles, rewards the companies that are currently most richly valued. Now that is a perverse outcome, and arguably a dangerous one. So one of the ideas behind peak passive is this notion that obviously you can't have the entire stock market managed passively, because then there would be no price discovery at all. The market would seize up. That cannot happen unless we want to give up on capitalism. One very famous paper out of Bernstein referring to passive investing as Marxism, which is an exaggeration, but there is a fair point there. That is what gives you the notion that we could at some point reach peak passive. I'm not sure myself that one thing I do find, and this has been true for a long time, since at least the last 20 years, conversations about passive have oscillated between two mathematical facts, and I'm not sure how interesting either of them is. One is you cannot possibly go to 100% passive owned, and the other is passive funds, because they have lower fees, you can always be certain that the average passive fund will beat the average active fund. Both of those statements are true. I'm not sure either of them, and that gives you the heart of the dilemma of working out how to deal with the whole passive phenomenon. I'm not sure how useful either of them are.
By the way, you confirmed that I'm not crazy, because I had Gene Epstein on one of these spaces also, and I had brought up that point about passive. You can argue is a form of socialism to an extent in terms of the influence on the economy, and you kind of alluded to that. So he seemed to be a little bit confused by the direction of it, but I think the way you explained it makes a lot of sense. Let me anybody again that wants to come up and ask questions, please make sure you click the bottom left mic request button, and please make sure you follow John Authers as well. Let's go to.
Well, I can't say I disagree. I agreed with more or less everything you said just then. Yes, it's a really It's a really difficult issue, and you also go to what I regard as somebody who's supposed I'm not being paid for advice per se, but I am being paid by Bloomberg, previously the FT, to offer general advice to people. I don't think it's a good idea in the broad sense for everybody to hold passive index funds. However, the base idea in the current situation, I don't think there's any better advice to give people than to hold index funds, unless they're prepared to do an awful lot of work on their own. And that is a real collective action problem, which it's very difficult to escape. I do think when you mention savings accounts, that's possibly where the opportunity to deal with this arises. And it's at this point that I start talking very boringly indeed, because I did spend time writing about pensions at one point, the notion of how pensions are regulated needs to be altered in such a way that you begin to move back to something more like that mimics the classic defined benefit plans, where it was much easier to invest for the very long term. So Canadian pension funds, as we know, these remarkable institutions that buy, that they will, the Caisse de dépôt in Quebec actually not only funded the building of a new metro in Montreal, they actually managed it and ran it themselves, because they were that confident about their ability to do active investing. We need some way of finding a format for long-term investing, such that you can actually hold long-term investments in there. The kind of idea that I've knocked around is, if you're making compulsory allocations at a young age, if you're in your 20s or 30s, you should probably have a default that goes straight to some pretty highfalutin, risky, illiquid stuff. Because if you genuinely can wait 35, 40 years for your money, that's probably, if it's well managed, going to be where it can give you the most ultimate bang for the buck. As it stands at the moment, that's very difficult to achieve. We've had a long period. You said hedge funds seem to be the way to go. I would argue it's more private equity, that because we discovered how painful it was when you had to mark stuff to market in 07 and 08, and because we got the idea that leverage was going to be more or less free forever, private equity looked like an absolutely fantastic deal for a long time. That is an area that concerns me in terms of where things could go really wrong over the next couple of years, is what lies in wait once not only commercial property, but real estate, not real estate, the commercial real estate, but also private equity. Once those start being marked to market, it's a little alarming to imagine what we might discover there. So that's my concern about this, about the response to the GFC. I think is perhaps that there was overexcitement about private investments that rely on leverage. I think in the same way hedge funds did fantastically out of the dot-com bubble. So many hedge funds had bet against the tech stocks and had long positions in all kinds of value stocks, that you actually had the average hedge fund, according to who you followed, actually made money in 2000 and 2001. And that's when you get the rise in the scale of hedge funds, the institutionalization of hedge funds, the loss of their edge, because they had become so much bigger and more institutionalized, comes in those years after the dot-com bust, when everybody thinks hedge funds have the answer. And then, of course, in 07, 08, they conspicuously failed to do so much better than anybody else had done. Yes, tell me about it. Okay, that prompts another thought, as I've been asking about, lessons I've learned. I had, in my early years at the Financial Times, I spent time writing about personal finance, which which was absolutely not my idea of an exciting time. I thought I was going to be, Woodward and Bernstein and meeting people in underground car parks. Instead, I was writing about pensions and tax shelters and stuff. But one of the things that was very interesting was you did get to see what the readership thought. And it was quite stunning that really very intelligent, sophisticated people, senior lawyers, surgeons, heads of marketing at large companies, came up with stunningly stupid ideas about what they should be investing in, or obviously really didn't understand critical elements of what you were writing about, that you really can be a pretty smart, educated person and not have a clue about this. And that is an issue for me, or it's one of the key things I have been wrestling with my entire career, is that I ultimately, when push comes to shove, I believe in free markets. I think they're like Winston Churchill famously said of democracy that it was the worst way of running a country apart from all the other ways that had ever been tried. And I feel much the same way about free markets. They're a terrible way of allocating capital. The only things that are worse are all the other ways that people have ever tried to allocate capital. So I believe in free markets and take the libertarian perspective. But it's obvious that when it comes to helping people save for retirement, it is actually necessary to be quite uncomfortably paternalistic with them. Yes, people do actually want it to be as simple as look right, look left, and cross when the light starts flashing. And it cannot be made that simple. But and when you try to create products or introduce new regulations to make it easier for people to channel their money into the stock market or other markets, what tends to happen is that you create incentives that you hadn't expected, that you move capital, move markets in ways that you didn't intend. And that is a very, very difficult circle to square. But certainly you can't just say, it's not acceptable just to say, here's the index, stick your money in that. And it's not acceptable. I've read Jeremy Siegel's books and all the rest of it, but you can't just say, have all of your money in the stock market all the time, because volatility does happen and you do want to retire at some point and start taking your savings out. So, it's you've put your finger on a very serious problem, and it's one that I've spent a large part of my career, trying but failing to answer. I take that point. Yes, it's very difficult to know how to address that, given that there is a desire for simplicity, and that's a perfectly reasonable, natural human desire. Just make life as easy for me as I'm putting my savings away as you can, please. Isn't an unreasonable attitude for people to take, but it actually ends up with, you come up with products that will look appealing and you have regulations that are designed to protect people, and you end up, without realizing it, encouraging everybody to go into the same thing. There are a number of examples of that kind of phenomenon over the years. I think the influence of people didn't realize how much power they had given to the ratings agencies when they're making regulations about whether you could invest in investment grade debt or not pre-GFC. And that meant that there was a lot of money to be made by hoodwinking their rating agencies into giving credit a higher rating than it deserved. Similarly, the spectacle of China, the world's second biggest country, desperately trying to persuade MSCI to include it in an index, because so much of emerging market investing revolved around the MSCI index. Nobody ever intended to endow MSCI, one private sector index provider with that kind of power, but it happened. I guess the other way of looking at it is that it's the inertia is very powerful. That if you give people a default simple option, they will take it, and that will become very powerful, and that in turn can be very dangerous.
Yeah, that by the way is I've tried for a while to get Richard Thaler on, but that's sort of one of his main, I think, concepts behind nudge, right? As far as the kind of, I think he called it paternal libertarianism, I think was the term he used in that book. Let's go to.
Okay, starting with Powell and Lagarde. Thanks to the energy crisis, Europe started somewhat behind because that gave such a big one-off hit to inflation. Having started later in the process, it probably does have to continue somewhat longer. They were out of sync entering the tightening phase with the Fed moving first, and it makes sense that the ECB will carry on for a little longer. One of the points that gets quite interesting there is the effect it's having on the dollar against the euro. That the dollar bulged last year, thanks in large parts to the Fed getting as aggressive as it did before the other developed market central banks, and it now looks as though that's going to go into reverse. I think the other point that's very interesting with regard to Europe and particularly Germany is their degree of exposure to China, that Europe has much more of a dilemma in dealing with China even than the US does. I haven't had the chance to examine the German factory orders in any detail yet, but I would imagine China has something to do with that. China buys a lot of manufactured goods from Germany. So that could be a sign that the rebound in China, the post-COVID zero rebound in China, is not moving as fast as we wanted or expected. If that's the case, that's definitely worse for Europe than for the US, and could therefore change some assumptions. I think when it comes to the banks themselves, there was a book a few years ago which referred to the global financial crisis as instead the North Atlantic financial crisis, which I think was quite a good way to look at it, in that what really happened there was partly that a bunch of American financial institutions made any number of loans that they shouldn't have made, but also that they found a ready buyer for it in the large and rather ungainly and over-regulated banks in Europe. So without the enthusiastic flows of money coming from various lousy European banks, you wouldn't have had it wouldn't have been as lucrative to extend money to subprime lenders, to subprime borrowers in the way that it was. So there was there was a symbiotic relationship, and the European banks, having already consolidated and having got all this toxic waste on their balance sheets, and having the problem of the poor construction of the euro, actually took far longer to recover in any meaningful way from the GFC than the US banks did. What we now have, however, is, and this has surprised me, but it's turned very quickly. European banks do appear now to be in somewhat better shape, in part because they've just not been able to get themselves into as much trouble as they were before, that they've been forced to draw in their horns, and also because they're more tightly regulated. I don't recommend the model, but it means they are less likely to go bust. They're less likely to crash. Meanwhile, in the case of the US, there was massive consolidation back in the 1990s, but there are still far more banks in the US per population than anywhere else in the developed world. And that does mean that you have all these institutions that could become vulnerable just because they've made an interest rate mismatch, that they've made the wrong duration bets. And that's what we're seeing. So very suddenly and very surprisingly, the US, what were strengths of the US system, that a lot of the banking system was in institutions that weren't too big to fail, has now become a relative weakness. While Europe has a banking system that you certainly wouldn't want if you were hoping for a dynamic economy, but that probably at this point in time is less likely to explode. Was that more or less clear? I'm enjoying myself. Sometimes giving you streams of consciousness, but was that sort of the point that you were interested in?
My stream of consciousness on Twitter usually involves a lot of cursing, so I can understand the last question, and then we'll wrap up.
In terms of de-dollarization, I am in general a skeptic on this. I do think it is being overhyped. And if you look at foreign exchange trading figures, the dollar still really is as dominant as it's ever been in terms of its share of transactions. In the most recent BIS data, which I think I'm right in saying was only last year, there are still far more transactions involving British pounds than Chinese yuan, which surprised me, but it tells you something. So, it's in terms of, is there anything imminent? No, there really isn't. And the moves that have been made recently that have created the coverage, these are small amounts of trade flow involving relatively small economies, like Argentina or whatever. I don't see it as being a clear, coherent threat to the sort of Bretton Woods dollar domination, exorbitant privilege world that we've been in for 50 years. That said, nothing is forever. As British people, we are aware that there used to be a different reserve currency across the world, and these things can change. I do see a weakening of the dollar in terms of its centrality to the system as being a natural consequence of the rather scary geopolitics we're seeing at the moment, when you're getting some new version of the Cold War arising, when there are different economic blocs emerging. The communist world wasn't part of Bretton Woods. It's now, in a rather uncomfortable way, it has been, to a greater or lesser extent, part of the Bretton Woods dollar-dominated system for a long time. I think it is natural that among the many ways they're trying to declare greater independence from the US, I think it is natural that you would see attempts to develop alternatives to the dollar. But in the case of China, it's very difficult to do that. There's the trilemma concept. It's very difficult to do that unless you're prepared to let capital flow freely both in and out. And I don't think they're ready yet to be able to do that. So is it an important subject that we should pay great attention to? Of course it is. The fraying of the order and the move towards a bipolar or multipolar world and the rise of China. These are hugely important topics, and the dollar will be a consequence of how the global landscape evolves. In terms of whether there is anything that really changes the needle, moves the needle now, in terms of the macroeconomy, in terms of financial markets, I am a skeptic on that. I don't buy that yet. No.
Everybody here, please again make sure you follow John Authers. John, what's the best way for people to track your writings and see your thoughts?
Okay, if you can follow me on Twitter at John Authers. I have the privilege of an unusual name, so it's at then JOHNAUTHERS, and you should find you can get my daily newsletter free. if you don't, by email. So if you go to me on Twitter, you should find a pinned tweet, which will give you details of how you can sign up to get me in your inbox every morning of the working week. My newsletter is called Points of Return. If you already have a subscription to Bloomberg, look for my name and you should be able to find it. Shouldn't take you too long to find a way to subscribe to it there.
Thank you everybody for joining.